The second outcome is actually one I mentioned first, which is we are just left with rest of world. And the first outcome is we preserve the group, but we have significant dilution. So all of us shareholders own some stake of US, UK, and rest of world, but they give off a ton of shares in order to pay down the debt. And what they would need to do is, in order to get out of Chapter 11, in 1 month's time, we would need to lose enough debt to get down to ×5 leverage over EBITDA. So EBITDA, earnings before interest, taxes, depreciation, amortization, is around 25% of revenue in 2019. So basically, what they need to do is work out what revenue is now. It wouldn't be wise to take the 2021 revenue. You'd want to take the essentially trailing 12 months, and we do not currently have access to that. So what we were sort of roughly thinking was that revenues in 2022 could be projected to be 3 billion based off of Avatar and various other factors. And so you have an EBITDA of 750 million, times that by 5. Also, you have to factor in that there is more debt now, because the debt number that we managed to get from their June filings the exact amount of finance debt they had. So how much debt did they actually owe in finance debt, not lease debt, nothing else other than sort of finance debt. We took the net finance debt, and then you can imagine that there's a lot more debt on top of that because they got the debtor in possessions, and also that was back in June. They issued that information. That's where it went up to. So we projected around 6 billion in debt and said, okay, they should have 4.5 to 5, but we think that the judge might be lenient to these guys and give them a little bit extra leverage so that they don't have to have as much dilution. But it really seems like if they do that, that will mean that Mookie and existing shareholders and existing board of directors are really fighting for shareholder equity if we have a high leveraged business coming out of this. But what we were looking at was around potentially up to, we are thinking 1.5 billion. Also, we were projecting high amounts of debt, and we're projecting like sort of large amounts of dilution, but we're saying like existing equity holders' current shares could go down to 4% of what they used to be worth. That is sort of being quite harsh with the numbers, but it is a potential outcome of the preserving of the group, but with dilution. The fact is that you would need to give up to 1.5 billion of equity away. And that would mean that's how many shares you would need to print in order to do that, to get the existing company to that point. Is we existing shareholders would be left with 4% of the company. Basically, if your average is 3 or 2p, there's almost no way that you could possibly lose. But if your average is higher, 20p up to 50p, then I think you need a lot more luck to get you guys back up to that point.